I've been calling for this year 35 to 45% decline, peak to trough, and that this is going to be a process, a move that is much more akin for those who have been in recent history, although a very different move in macro ways. Something much more akin to a tech bubble plus a great financial crisis kind of 1 year plus type move.
In his last two appearances on this program, today's guest predicted the markets would start to become more volatile. In the fall, he didn't necessarily think that would mean lower stock prices, and he was proven correct. But he did express worry that as we entered 2025, continued higher volatility would start to become a real problem for investors, and boy, did he nail things with that prediction. Volatile is perhaps a gentle word for the major market swings we've seen this year, especially over just the past week. To find out where he sees things headed from here, we're fortunate to welcome back to the program Cem Karsan, founder, CIO, and managing principal of Kai Volatility Advisors and Kai Wealth, widely known as Cem karsan. Cem, thanks so much for joining us today.
Wonderful being here. Thanks for having me back, Adam.
All right. Well, Cem, look, as I said earlier in the intro, I think you should take right now a very well-deserved victory lap. You were out there predicting volatility. It arrived pretty much on schedule with how you told us to expect it. And it's behaved so far, at least, like you thought it would. You didn't think it was going to weigh on prices running up to the end of 2024. You said that's likely to change in 2025. It certainly has. On the day we're recording this, it's the day after the historic tremendous jump in the markets, the S&P up almost 10% in a single day. It looks like it's lost at least half that at the time we're recording here, although it's been bouncing all around so far today, so who knows where it's going to end up. But this is, I'm sure, the most volatile period in markets in recent memory for most folks on Wall Street. So first off, kudos, congratulations. And secondly, more importantly, if you could just do us a recap give us a recap of kind of what got us here on the volatility side of things, and then whether we should prepare for similar volatility going forward, less volatility, maybe even more volatility.
Yeah, and I'm not one to hype up the wins. Again, the second you do, there's a incorrect call coming around the corner, right? Like
you don't want to tempt fate and get fate angry, but also too, you got to take them when you can take them.
Yeah.
This was a great prediction.
We've been, I can say we've been pretty spot on for over a year. At this point, we expected we said 20 to 25% up market in 2024. It was election year. We talked about kind of the likelihoods of that, and we expected it to crescendo either in end of December or mid-January, which it did. We did expect a small vol event in the fall. We got one in August. It was a little earlier than our September expectations, but followed by a big rally into and through the election. So all those things happened when vol got to its nadir in December after the election. That was structural. It was a function of effects that are effective positioning and where things go. A really effective December vol compressing, and that being the highest vol for lots of reasons, and giving people really, really cheap vol behind it, and leading to selling at already too low levels. And our view was that after December expiration, that would mark the low in volatility for a year. And so sure enough, was the high in the markets and the low in volatility. We also said that expect a major decline to begin 10 to 15%, we said. So we weren't perfect, right? It was the decline got down to 22% at its worst case. But we did expect that from February expiration. We said the Wednesday to Friday, and we said this starting in December, the Wednesday to Friday of February expiration into March expiration. That's where the majority of the first part of the decline came. We did get that 10 to I think it was 12% in that cycle. But then, like I said, got a continuation of 10% or so more on the tariffs, and an even greater volatility spike. So our general view, which has been incorrect, I can say that, was that we would get a big counter trend rally here starting in April. It hasn't happened yet. We did get a 10% rally yesterday.
Yeah,
I'll call
you
that a
were right
counter
as
trend
of a
rally.
couple hours ago, but yeah,
Yes,
now it's
yeah.
all changed. Yeah.
Yeah, and by the way, like you're not going to get every single point day, everything right. This is about probabilities. That's how we make these predictions. When there's a confluence of probabilities and time that point to certain paths being the most likely, we're able to make. That's how we're able to make these predictions through kind of looking at positioning in the options markets and also overlaying liquidity realities on a much longer month, quarterly, annual time frame and play out path. But that counter trend rally, even though we got this kind of this 10% thing in one day yesterday, has yet to play out. And that one we or is it currently playing out? We will see. That we believed would take us to anywhere from 5,800 to 6,250 back towards the highs. This is what we're talking about in December, when we mapped out everything. We've been again pretty much exactly right to this point, except for a greater draw and no rally back, no meaningful rally back yet. Depending on how you look at meaningful, we think that will likely still happen, but not to the highs. We think that range of the rally back is likely to be significantly lower now. Meaning instead of 5,800 to 6,200, 5,650 to 6,000. We are optimistic that it will still play out, but there are a lot of other factors at play now, right? The tariff, we expected a tariff war, the scale and the kind of rollout of it, the lack of working with the Federal Reserve and the unwillingness, importantly, of the Federal Reserve to help backstop volatility in this environment has been notable. I think we would have expected more dovish responses from the Federal Reserve by this point. That's part of why we thought the market would A, bounce back more, and B, have a less of a deep tail. And that's not happened. Actually, the opposite. When I think the real continuation of the tail, if you think about it, this last Friday was when at 11 o'clock Central, when Powell came out hawkish after the tariff rollout, and I think that's very important in telling and how the future of this move plays out. That said, I think you know this, Adam. I've been calling for this year 35 to 45% decline, peak to trough, and I've done that publicly for 3-4 months at least. We believe that is not again going to happen on this first move. We believe that this is the end of chapter 1 of 4 or 5 chapters, and that this is going to be a process, a move that is much more akin for those who have been in recent history, although a very different move in macro ways. Something much more akin to a tech bubble plus a great financial crisis kind of 1 year plus type move. We don't think it'll cut as deep. Again, 35 to 45% is not the 50 to 75% right type things we saw in those markets, depending on the markets you're looking at. But still, in some ways, more painful, because relative to what we believe will be sticky interest rates and the long bond and eventually higher bond yields, which we've called for at the same time, a very stagflationary environment, very different than the last two, the Federal Reserve will be neutered during this time and unable to really assist. And in again, relative to the costs, that the tape or the thinking of valuations of the market will actually be worse than what we saw in those other periods. Because of and portfolios will be less cushioned by the bond part of their portfolio as well. So a painful, maybe more painful move, despite less of a decline in equity markets ultimately. But that is our view. It doesn't mean it's all going to be a 60 VIX all the way, right? You can get a 35 to 45% decline over the course of a year and change, and have volatility go down, which I think right now everybody is on volatility is going to stick at 50, 60, for the year. We don't believe that. That doesn't mean it's going to collapse. On a fixed strike basis, we believe it'll come down, but you will slide to higher vols into a 35-45% decline. So I think the next chapter is more likely to be something between Trump election 1.0 in terms of the short-term volatility, and then a kind of 22 step down, but bigger steps, in terms of the decline and longer-term vol.
All right. That's a great kickoff answer because you answered probably like 5 of the questions I had here that I was planning on answering you. So thank you. You're making my job easy as the interviewer. And I'm glad you ended with that last sort of explanation. So it sounds like you think in the immediate term, still going to be pretty whippy, but as we go through the year and if we actually manifest that 35% to 45% decline, you think that's going to be maybe more like 2022, where it's just a slow grind down. Bonds aren't helping. It's not necessarily super volatile. It just sort of inexorably just keeps grinding down.
Yeah, I think so. A couple of things. One, I don't think it's exactly like 22, to be clear. I think it's bigger, right? 22, we saw what, 25 to 27% was the low. I think we're going to get to
about twice
almost twice that.
Yeah.
But we've already done a lot of that, right? We've taken, I think we're down 15 or so percent here, right?
Right.
So,
but if we bounce, just to start to interrupt, but if you're right and we bounce back up to 600, we restart the clock pretty much. Yeah.
Yeah. I mean, then you're down 7% or so, and then you got another, 35% to go, right? Yes. And so, again, it will be whippy. So I think it'll be more whippy than 22 will. That said, I think it will become a trend. And I think vols are already quite high, in the skew. Like if you go look at down 45% from here in the market, and or from 30% from here, and you look at the puts down there, they're already on a very high vol. Mm-hmm. And so my point is, on a fixed strike basis, as we slide those puts, that vol will likely go lower net. That doesn't mean you won't get paid on the actual realized volatility, because I do think we'll have quite a bit. And importantly, this is, when markets get cut in half, there is more structural stress throughout the market. And if that happens while the 10-year is still hanging in, or maybe even going higher, that could cause all kinds of other financial stress in big entities that could lead to things. But I do think it's different than 22. Yeah, okay. I want to be clear. I think relative to the vol that we've now seen, which, by the way, was in line, the high in vol was higher than COVID just now.
Wow.
Like, people don't have that context right now. This is not COVID. That said, I think the decline peak to trough will be greater than COVID, and it will last over the course of a year and change, which is more in line with the great financial crisis or other things like that. So, we're talking about a very historic type of move when we start talking about a 35-45% decline. They don't come around all the time, much less, with rising interest rates. This is more in line, in our view, to 1969 to 1970. And that, I think, is the historical context under which we need to look at it and think about it.
Okay. All right. So, again, presuming you're right here, I have a lot of experts that have appeared on the channel who have said we haven't had a true bear market really in a long time. It kind of looked like we were beginning to have one in 2022, and what they mean by that is true bear markets end in capitulation, where everybody just gives up on stocks, right? And says, I don't want to touch these things again. And we were starting to see that near the end of 2022, but not totally. There were still a lot of people there trying to catch the bottom. And of course, a lot of people did at the end of 2022, and then they rode, a great 2-year ride from there. Sounds like the vibe I'm getting from you is that, this will feel like a pretty big protracted bear market. And I'm assuming it wouldn't surprise you that it would end with that type of capitulation.
Adam, I want to back up for a second and give some context. I think this will be helpful to your listeners. In 2020, we started talking publicly. We privately had these conversations even prior to how we were really beginning a populist period of a rebalancing of inequality, and politically this was fairly inevitable. People have talked about this in terms of fourth turning and other things, but it's a demographic reality. The political dominance of a generation is just beginning. That millennial generation will reach its peak in political dominance by 2034. We are still 9 years away from that. And the last time we saw these political pressures that drove protectionism, that's why the tariffs are happening, that drove populism, that's why the massive fiscal spending happened under Biden. The last time we saw these things, we saw very similar outcomes. It rhymes very, very closely. And the outcome from that period, which is 1968 to 1982, is equity markets went nowhere for 14 years. And in real terms, lost 67% of their value, 2/3 of their value. That's the context where I want people to think about, like zoom out. And guess what? 2021, we said, look, we think this is the beginning of the lost decade. And what's happened since 2021? We can focus on 21, we can focus on 22, sorry, we can focus on 23, 24. We went down 25%. We went up 25%. We went up another 25%. And then we went down 25%. We've gone nowhere.
Right.
There's a lot of volatility up and everybody grandstanding and saying, woo, it's a bull market. And then
at your point, if you look at it on a real basis, it's actually lost value.
In a real basis, we've lost probably 20%. Meanwhile, what's happened to the 10-year? What we said would happen starting in 2021. It reached its bottom and now rallied to 4.5%, 5%. And guess what? It's not over. And if there's one thing we learned this week, is that the market going down and the odds of recession going up are not going to do the same things to the 10-year and the 30-year that's done in the last 40 years.
Okay. That's
the most important information we've received this week. And it's the same thing we've been talking about for 5 years. We are just a couple years in, right? Call it 4 years into what we believe is a 14-year, 13-year type reality. We can focus on are we going down 35, 45% this year? And we're good, by the way, at the timing part as well. But I think that what makes us able to do that is also having a bigger context, a bigger zoom out on where we are and what the macro realities are as well.
All right, so that's maybe the answer to a question I was planning on asking. So Cem, I went to business school, and the class we all thought was the biggest waste of our time turned out to probably be the most important class that we took, which I can't remember the exact name of it, but it was we all called it non-markets. And it was all the things that weren't natural market forces. So regulations, central banking, the stuff that was just back in the 90s when the internet was booming, right? It was just so dusty and dull, right? And I'm curious, because this year, especially so far, the non-market factor has been so important, right? I mean, the game changes several times a day practically with these, new policy declarations or changes. My question was going to be, does that make your job harder? Because you can't just look at the market data. You sort of have to anticipate what these non-market players might decide to do. But it sounds like you're already looking at this era we're in with the construct that there is going to be a lot more non-market activity. So maybe that's what you're betting on. How does that play in?
Yeah, so I've said this to you before. It's an important construct for anybody who's looking at markets. There's the weighing machine, right? In the words of Benjamin Graham, and the voting machine, right? The part I just said when I zoomed out was the weighing machine. You think about if you got that right, by the way, for the last 40 years, you are an infinitely wealthy person. If you understood that we were running a supply side economic model, that the Federal Reserve was going to take secularly the 10-year from 20 to 0 for 40 years, And every time we had a market issue, would just stimulate more, and we'd run into a deflationary environment. You'd get globalization. You would have every single bet would be obvious. Now, that doesn't mean the tech bubble wouldn't have happened, that you wouldn't have had a massive drawdown. That doesn't mean the great financial crisis wouldn't have happened. But you would know to favor growth, to favor buy the dips with size when the Federal Reserve acted. This was a secular view that you had to have at the time. And you had to be, when everybody lost faith in it, you had to kind of, that was one of the best times to keep pushing that. And the reality is that secular weighing machine and the realities of it, which are demographic and political, it's favoring, median outcomes over mean outcomes, and not maximizing GDP, but maximizing median, again, GDP or income. If we believe that to be true, which I do secularly, and you need to consistently bet on that trade, even though it's not going to be a straight line. And the moment that people lose faith in that trade, those are when the best trades happen. And we've seen that a couple times. We've seen transitory 1.0, 2.0, deflation coming. Everybody just a month ago was out here saying 10 years going to 3. I told you so. Guess what? It's not. So I think that's, you got to start there. You got to look at the macro. You got to look at the weighing machine. You got to understand where valuations are, what happens when this is the case, map out the outcomes and where the final destinations are likely to be. And then you go to the short term and you look at the flows and you look at the weekly, monthly, quarterly, annual realities of, and so we do that. What's made it a little bit more complex, and in these environments is more complicated, right, is in a monetary driven regime. It's very simple. The Federal Reserve has dominance. They're able to do unlimited QE, and QE is deflationary structurally, as long as there are no inflationary pressures. They're not getting fiscal spending, rebalancing, protectionism, et cetera. In this environment, the Fed loses control. And so that creates instability. Imagine a situation where we have a room, and I may have used this analogy before. I'll maybe do it better this time.
But it never hurts to repeat things to make the lesson sink in. But
imagine a room where you have one dominant entity, like one guy who's 400 pounds, ripped, fastest, strongest, has all the weapons, whatever. He is
the biggest guy in the prison yard.
Yeah, he's all powerful. He runs that place, and it is relatively stable. If something happens, it's taken care of. Now imagine you have that guy is sort of like injured. Something happens to him. He loses his guns. Now there's a power struggle. And there are other entities. There are other, there's vacuums of power. These are, in the short term, much less predictable, right? They are, the outcomes in the short term are dependent on many more factors, many more incentives, many more interplay of dimensional relationships. So that's where we are now. The Federal Reserve, and again, at the core, I want to be clear, the story that's the most important now is not tariffs, as much as that's what everybody's focused on. What's most important is the 10-year and the 30-year bond and inflation in the face of economic slowdown. It's the favoring of median outcomes, which tariffs are part of, but far from the only important thing here. At the end of the day, I mean, don't forget the reason the equity markets went nowhere from 1968 to 1982. There's two reasons, but the most important reason is because interest rates went from 3.5 to 20. Why is that the most important thing? And again, I feel like most wealth advisors have no context or no understanding of the most important thing you learn in economics 101, which is net present value. Right? It's like the first thing you learn. Discount rate, right? It's kind of important. You can't have a 25 PE. 25 PE makes sense if interest rates at the 10 years 3.5. Maybe. I mean, it's still stretched, but that's where it was in 1968. 24, 25, and interest rate, the 10-year was 3.5. Well, how am I doing that? Just flip it. What's the earnings yield of the S&P, right? Like these things matter. If you can get a 3.5% 10-year yield, you probably need more of a return, right, from the S&P, given the risk that it embodies, as opposed to risk-free, right? All right, well, 25 is at a 4 earnings yield, right? And then you assume there's some growth, to it, and you get a little bit more, okay? Well, 1982, where was the PE of the S&P 500? Oh, it was at 20% 10-year, and the PE was 4.5.
Mm-hmm.
Yeah, it's logical. But if you look and show somebody like a 4.5 PE, people are like, how is that possible? 4.5 PE,
Right.
why would you ever? But to go from a 25 PE to a 5 PE means you need to lose 80%. Right? You have to lose 80%. By the way, earnings haven't changed. The companies are still making the same amount of money under that assumption. It's the same market. All that changes, interest rates went higher.
Right. The discount rate, that your weighted cost of capital.
But nobody thinks about that. If you talk to your average person, your average wealth advisor, like the economy is strong, you want to be in stocks. Or they'll tell you, hey, it's inflationary right now, you want to be in stocks because they're a great inflation hedge. Both of those things are utterly incorrect. Like they're just wrong. Okay. And this is why, because of the discount rate. It's about as simple a math as it comes. On top of that, there is a second reason. During inflationary periods, there's just less liquidity, right?
Mm-hmm.
So it's harder to invest. There's less trade, right? And it breaks down earnings. So GDP actually 68 to 82. I've used that analogy a lot. I've beaten it to a pulp, but I use it because it's the most recent and easiest to kind of refer to. There are other periods, but record profit margins in 68 for its time period. By 1982, record bad profit margins. Well, where are we now? Record profit margins. Well, what happens to profit margins when interest rates go up? They collapse. When interest rates go up at the back, inflation happens. Guess what? You have tariffs. That's not good for earnings, relative to it may be good for GDP growth, by the way, in the U.S. It really might be, right? You're going to get more jobs here. Not maybe the jobs you want, but you better believe the cost of creating an iPhone is going to go up. You better believe the cost of the input cost. So what happens is labor gets a larger share of, that's what populism is, a larger share of income, and GDP growth can be strong. The economy was stronger in 1968 to 82 than it has been for the last 40 years. For 14 years, the S&P 500 in real terms lost 7%. So it's not about growth. It's about earnings yield, discount rate, and then last, profit margins. And both of those things do very poorly if interest rates go up.
Okay. So I understand all that logic, and I think I know what your answer is going to be, but let me just ask it anyways. So the end of that sort of lost decade and a half period, right, was 82. And that's right after that was really when the Reagan reforms really started heating up the American economy on a relative basis. So presumably that's what the Trump administration is trying to do right now, right? Is to do a lot of things that are going to goose the American. It's going to be a big, beautiful economy. Jim.
That's 100% what they're trying to do. They've
Right.
been very vocal about it. The problem is context. They think about the world as like all times are equal. Do you think that Volcker, and Volcker's painted as vanquishing inflation, right? And that Reagan was the first guy to come up with supply side economics and decreasing taxes. They're painted as heroes. They're not the heroes. They're the right people at the right time. But if either of those people came along, which there were many efforts to do so in 1969, they would have failed. And actually, they did. Because Nixon was a supply side economist. He was a Republican. He opened China. He took us off the gold standard, right? He brought in Arthur Burns to stimulate with massive QE, monetary policy driven policy. They tried to do this in 1969.
So they just got steamrolled by the trends.
And guess where it ended? It ended with price controls
Yeah.
and Watergate. Why? did it not work there? And it worked in 1982? Demographics. The reality is people politically in 1969, meaning the younger generation, which was coming to political dominance, wanted fairness. They wanted to improve equality. Sound familiar? They wanted to improve median outcomes. That's what led to the war against the Cold War and communism. That's what led to the hot war in Vietnam. That's what led to it's all the protectionism that was happening at the time, right? And the fiscal spending and Great Society program. Sound familiar? So if you do monetary policy at the time, which they tried to do, guess when the real inflation started? It didn't start with the Great Society program. That's a major driver. It didn't start when the Vietnam War started. It started under Nixon. That's when the real inflation started. The dates I gave you are 1968 to 1982. Nixon became president January 1st or January 20th, whatever, 1969. And so if you think the supply side model is going to work and solve everything and lower taxes and monetary policy, good luck.
Okay.
I mean, good luck, because the political realities won't allow it. And that's why when they started saying this just 2 months ago, I was very public, like, okay, just wait for the pitchforks on your lawn.
Okay.
And so that's what we've gotten, pitchforks. I mean, look around. How is sentiment now relative to where it was 2 months ago?
Oh, sure. And I mean, first off, I think the administration would say, well, hey, come on, Jim, give us some time here. But what I hear you saying is, hey, I will, but I don't think you're going to win out over the demographics here. Is it possible, and I think you would say it could be possible, but don't let me put words in your mouth, that the economy could actually do quite well, and we may raise median outcomes, but the markets might not do so great, right? Which would sort of truly be we're putting Main Street over Wall Street, which is what the administration is sort of giving lip service to. But do you see that type of outcome as likely in the next couple of years, or do you see something different?
That's the most likely outcome.
Okay. Yeah, which on a social basis, a lot of people might say, fine, not everybody, but I think there's a number of people that are disappointed enough with how things have been going to say, yeah, like maybe
that's
let
why it's
labor
happening.
stay in the sun.
That's why it's happening. That's why it's happening. Now, to be clear, that's what happened 60s and 70s. The problem with this approach is, yes, incrementally, you get a rebalancing. But to be clear, people weren't very happy in the 70s about the economic outcomes.
Especially when they were standing in line.
Yeah, definitely not the wealthy. Definitely not the wealthy.
Yeah.
And the poor as well, because of inflation, right? Inflation's a flat tax. So the great irony here, and this is now really philosophical, is fairness is not it's not a natural construct.
Right.
There is no such thing as fair. Your mother told you that probably when you were little.
Right.
Life isn't fair.
And the Pareto principle rules all over the universe, right? Similarly in societies, yeah.
So if we try and create an unnatural construct like fairness, which, by the way, I'm not against. I think fairness matters. I think justice matters. I think, liberty matters. That's me. Not everybody believes that. But if we believe that matters and we're going against nature and doing it, guess what? It's not efficient. And guess what? That means even if we get great demand and great GDP growth and we get better median outcomes, that economically will get slower, like not slower GDP growth necessarily, but less economic, less technological development, less progress.
Okay.
And there is a reality where a rising tide lifts all ships. I'm not a big trickle-down economics fan, but if Socrates said, do you give the best violin players the best violins or the worst violin players the best violins? Right. And, his answer finally was, you give the best violin players the best violins because it creates infinitely beautiful music.
Right.
And there's some truth to that.
All right. Well, look, One, Jim, it's always so super fascinating talking to you. But I'm sure you've got a lot of people's attention now of like, oh God, I mean, we might be having this lost decade or more where my portfolio is going to really struggle here. So let me ask you a couple of questions about your investing approach, both short term and long term. First off is I'm presuming that your funds have done pretty well so far this
Yes.
year, given that it's the type of environment you were expecting, but could you
Yes. Yeah.
provide me clear?
We are
Okay.
crushing it in our funds as we speak. Yes.
Okay.
Long
Glad to,
volatility funds, dealer flow funds. Yes, those are doing very well in this environment and have really been for the last 6 months.
all right. Well, first off, congratulations and incredibly well deserved. I'm curious, because you talked about what you thought was going to happen and some things you got right, some things you got wrong. In general, when you are investing for volatility, are you investing for volatility, meaning just faster rates of change, or do you need to be getting the direction right as well in the way in which you place your positions?
Yeah, so I want to be clear. We have two businesses. We have our volatility, our hedge fund business, where people can invest in our funds, and those are there's several. I'm not going to go through all of them right now, but those can be for volatility, just long volatility, or trading directionally, depending on the fund. But we do those with options, and what the key here is we're not long or short. We are making predictions forward, and this is, I think, a big difference in the approach. And this is very important. We pick probable paths. What path? Right? When you think about options, they're probabilistic distribution of outcomes.
Mm-hmm.
So you don't have to take exposure to the whole distribution of outcomes. That's actually quite silly. If you don't have any information or any advantage over all the parts of the distribution, why would you bet on all of them? Why would you take all that risk? Right. So what we do is we model what we know and based on supply and demand and incentives and likelihoods, and we model a distribution of outcomes. And then we look at the pricing and we say, okay, where are the home run bets? And they may be sometimes long, right, and short. There might be multiple paths that are just much more highly probable than all the others. And so we are doing prediction, but we're not taking all this risk of up or down as much as people think. So when I talk about the path, and when I talk about, people hear up, down, right? Like, oh, we're going up or down. But what you'll hear in the nuance is that I'm talking about very specific times and very specific paths. And I think that really confuses people. Like, how can he be so? It's because we're looking at where the confluence of paths are. And when I bet on that, I don't bet up or down. I don't just sell stock or buy stock. We bet on the path itself, because on a risk-adjusted basis, that's where you're going to really dramatically outperform. Okay. Mm-hmm. So that's what we're doing when we play in our funds, right? Like, that's what we're doing, whether it's long volatility, which is really focused on a long volatility convex approach and looking at the most probable paths relative to risk. And there can be a directional element to that, right? We could be generally short, but focused on a path that's short. Or in dealer flow, we might be long and short at times, sometimes at the same time, right? And picking paths that are more probable. So that's what's happening on our funds. On the Kai Wealth side, which we've been around for about a year, we are managing high net worth and family office money as a wealth advisor, and we're doing that in a non-correlated asset allocation model. And so we're doing that. We think 60-40 is debt. We think stocks and bonds are not a well risk managed, not an optimal approach. We don't think that's true in general, by the way. If you look at 125 years of history, I can go into the numbers if you'd like, but not very good. Running portfolios with long stocks and long bonds, even though it's been great, well, not great, relatively good the last 35 years or so. And by the way, not great, like a 0.6 Sharpe ratio of 60-40 stocks and bonds, with 12%, 11.5% type returns the last 35 years. Over 125 years, if you look at full cycle, and you probably should do that, even though that sounds like a lot, because the last 35 years don't have interest rates going anywhere, which is the most important thing. We just talked about that. Don't have interest rates going anywhere from except top left to bottom right. So if you really zoom out and look at the full history and look at a scenario where actually interest rates could go the other way, much worse, 0.4 Sharpe to this combination, and the returns are 9%, 9.5%. And so if you want to tell me you want to manage my money and tell me a asset allocation model that you're going to use is going to be 0.4 Sharpe, you can take a hike. I have no interest in that. We can do that we can get 3 times the Sharpe ratios with much more non-correlated investments. The reason most wealth advisors do 60-40 stocks and bonds is, guess why? It's easy.
Yes, you say easy. Yeah.
It's scalable. It doesn't take any real expertise. And it's worked, and there's recency bias. And as long as it comes back quickly, people forget quickly and are willing to put up with it. When's the last time we saw a decline that lasted longer than 3 years? 40 years.
Yeah, long time ago.
40 years. Why do you think private equities become so big? Because it's a 10-year duration. Nothing is marked to market. You take the mark-to-market volatility out of the equation, and then you leverage the equity, and you charge 2 and 20.
I was going to say, you get your 2% every year, and if you're lucky and or you're good and get returns.
I don't know what planet you sell that as an alternative. I'm going to take your money. You're no longer going to see the volatility. We're going to leverage it by 2x, and we're going to charge you 2 and 20, and we're going to call it an alternative to your equities. That is literally what private equity is. And so the point here is the reason everything that's gotten so big has gotten big is because it's been easy and scalable, and we've had interest rates go from top left to bottom right. Now, I talked about 125 years of history and the Sharpe ratio not being good. How do you think it is when interest rates go bottom left to top right, as opposed to the better scenario, top left to bottom right?
Right. Worse. At
You
least
know what that
worse,
Sharpe ratio is? Negative infinity. Because both lose money over 14 years, and you get lots of volatility. So probably not somewhere to be. I am a market maker. I was a market maker, ran one of the biggest market making operations in the options world during the great financial crisis. What a market maker is, by definition, is a risk manager. You absorb all kinds of liquidity, and your job is to offset all the trade's volatility from 10 dimensions, right? And to extract a yield. If you want a good risk manager, hire a market maker, period, full stop. My job as a wealth advisor is to manage risk. I don't know many wealth advisors that actually manage risk. They'll tell you, oh, you can expect 10% a year. And if you know how they manage risk, increase the timeline. If you're only going to be around for 15 years, let's decrease the amount of, let's not go 60-40, let's go 50-50. That's not risk management. How about we manage risk to interest rates, which are the biggest risk, period? Right? How about we manage risk to beta? So anyway, no, I'll get off my soapbox, but these are our businesses.
But stand just for a second and just let us know. So I think people are thinking, okay, well, if he's not sort of investing sort of traditionally in stocks or bonds, like what is he investing in that is non-correlated? What strategies is he using that's really different?
Yeah, great question. So it's okay to do bonds. The risk in bonds is duration and credit risk. So avoid duration and credit risk. Well, how do you do that? Well, we do something called yield stacking, which is taking short duration T-bill equivalents. We do boxes in the S&P 500, and then we overlay non-correlated strategies that are not duration risk, not credit risk, statistical risk, right? That don't have a tail, defined risk, and we create a yield, low leverage, customized to people. For people in their own managed account, essentially structured product construction for people themselves that generate yield. Okay, so we do that.
Sorry to interrupt, but is that like a turtle strategy? Just get the low return that's safe and just keep compounding it, or
no?
Okay.
Absolutely not. The yields on the average yields, and again, I can't talk about this in podcast form for compliance reasons, probably. Mm-hmm. So I'll kind of leave that off here, but I'll say you can do very, very well, and these are tax advantaged as well. So you're doing strategies in the S&P 500 index or futures, which gets you a 60-40 tax treatment, 1256 tax gains. So you're not paying ordinary income. You got a benefit there. There's some regulatory arbitrage. These boxes tend to trade above T-bill yields. So you get a lot of really low risk, high improvement of your duration. Plus you're able to stack a yield on top of that with non-correlated strategies. So anyway, this is what we're doing on the bond side. Okay. We're doing a yield strategy, and we don't do 40%, we do 30%. No credit risk, no duration risk, but less. On the equity side, we're not saying do no equities. We do 30% equities, not 60. And we don't do it passively. Okay, so what do? We're not just in the S&P 500. We're investing in things, again, managing risk. What's the risk here? Again, exposure to higher interest rates, higher labor costs, the issues that we're seeing. So let's take those risks off the table. What companies do really well when interest rates go up or when inflation is existent? Let's think about that. And by the way, they do okay if it doesn't. We're not saying that this outcome has to happen. Right? Guess what? A value-based approach. There's a guy named Warren Buffett who started in the 60s and 70s. You may have heard of him.
Yep.
Yeah, he did pretty well by not only taking a value approach, which has been very unpopular for the last 20 years. Right? Not only did very well by taking a value approach, which is a big part of it. Cash flow matters. Right? But he also happened to invest in things like insurance businesses. Why are insurance businesses great? Because guess what? When inflation goes up and the margins compress for all these other companies, their margins go up.
Right, because it's inflation adjusting. Yeah, exactly.
It's leverage to inflation.
Yeah.
Because they get the money first. They make the inflation. They pay it. And so insurance companies, asset managers, exchanges, brokerages, I could go on. There's plenty of businesses that do very well in inflationary periods and can protect their margins. Still will get hurt by multiple contraction, but at least their margins are improving, that you'll counteract that. So we do 30% equities, diversified, 50 names, we do it ourselves. We still have a beta on that. It may be a 0.5 beta. And by the way, it's not really a beta because it should dramatically outperform its beta, which it has, by the way, in this recent decline.
Okay.
But you then hedge out the beta with a long vol allocation. And we have a long vol strategy, which again, I can't talk about the returns, but it's done very well. I'm happy to have people reach out if they're interested. And we allocate 10% of allocation to the long vol fund, which offsets the, call it 30% allocation, half a beta. That's about a 15% beta of the whole portfolio, right? And we can offset that with a 10% allocation with a -1.5 to 2 beta with positive alpha was what we've been able to achieve at least. And we've been running that strategy for a long time. Right. That's our core to our expertise. So it's a value we're able to provide, which leaves how much? 30, 30, 10, up to 70%, 30% true alternatives, non-correlated strategies. Go to your wealth advisor, ask them for alternatives. Guess what they're going to give you? Private equity, private credit, real estate, right? Those are not alternatives. You can't just put the word private, take it off the market, leverage it, and then call it an alternative, whether it's on the credit side or on the equity side, right? So multi-strategy hedge funds, multi-strategy funds that have non-correlated exposure. And we have one internal, our diversified alternatives fund. We have others externally that we allocate to and that we work with. But we are getting people exposure to true alternative strategies in a non-correlated approach. And that's that gets us to a 0 beta. And you can generate a much better risk-adjusted return by taking that kind of approach.
On that last one, and this is not personal financial advice, folks.
Yeah, I want to be clear. This is not financial advice. These are all just generally how we go about managing our portfolios. If you're interested, please reach out. We can have a personal conversation about the products and things we offer. So.
All right, but to help people just get an understanding, can you give an example of one of these non-correlated alternative assets, just so they know how to think about them differently from?
Oh, yeah, they're not assets. That's the number one thing. They're not assets. I think the big problem here is that most people think investing is only owning an asset. That's wrong.
I think most people would if you ask them. So yeah, so
it's like if you think about risk management, the whole idea is if all we do is own assets, don't you think that's kind of correlated to one another? Right? Particularly as it relates to interest rates going up or down?
Mm-hmm.
Yes. That's not risk management. That's just taking an all-out long bet and crossing your fingers and hoping things go well. Okay, so the problem here is people are not non-correlated. They're not managing risk. They're all in the same type of correlation, right? So the key here is you can invest, and this is what hedge funds do, and this is what relative value trades are all about. You can trade, you can invest in trading strategies, niche businesses that ultimately are not correlated. They're not owning an asset. And I'll give you some examples here. You have the most obvious ones, which are long short equity, long short credit, commodity focused relative value trade. So you have a group that we know that trades natural gas versus the crack spread. That's pretty non-correlated. FX trading strategies, right? Doing pairs, global macro. Insurance linked strategies, life settlements, reinsurance strategies, volatility arbitrage, statistical arbitrage, merger arbitrage, convertible arbitrage, event-driven strategies. I could go on. There's 50, at least 50 market strategies that hedge funds deploy and that have real edge, real proven alpha. The reason that they're not as interesting to most people, or haven't been until recently, is because when people see a non-correlated strategy that makes risk-free plus 5%, right? When interest rates are zero, they look at it and they say, oh, this strategy only makes 5%. Why would I invest in this thing? Right? But then, and by the way, the Sharpe ratios of it are better, but people again are like, they don't think about risk. Risk is like, if I'm only gonna make 5%, like I don't care if it's zero risk, I'm not interested. But guess what? When interest rates go to 5%, now you make 10%. And guess what? The volatility is still really low. And guess what? Now the equity market, which has a forward return of probably zero and massive volatility, now you start looking at non-correlated strategies and be like, huh, that's pretty good.
That's pretty good. Yeah.
So that's the reality. And that's real alpha. Markets don't give you alpha. These strategies have been making 5-6% alpha per year forever. It's just the alpha is non-correlated and the risk-free was zero. So people are like, meh, I don't really care about Sharpe ratios. And so that's why people have not. But by the way, when did hedge funds and derivatives all come into existence? 1960s and 70s. Not a coincidence.
Interesting. Yeah, and obviously when we've been in, for the most part in the past decade plus, this era of passive investing where it was easy and you could make double-digit returns. So what if this thing's generating 6% of alpha every year? I don't care. It's not impressive versus what I can just do, buying the market and just hodling and buying the dips and stuff. But now in this new era you're talking about, on a relative basis, starts to look way more attractive.
Yeah, absolutely. And again, if we don't know what era we're in, what I'm talking about is better over the long run on a risk-adjusted basis and absolute return basis. So I want to be clear, it's not just about this regime. In this regime, it's not even close, if we're right about the regime.
Yeah. All right. Well, look, Cem, that was really helpful. Thank you, especially for going through those examples, because I'm going to bet that most people listening hadn't even heard about at least half of those things, right? And what I want to underscore here, which I do a lot on this program, is if what you got to be as an investor is just honest with yourself, right? What type of investor are you? What are you investing for? And what's the best way to execute on that? Do it yourself as a DIY investor, or to find somebody who's got the expertise that matches the era that we're in, right? You've made a really compelling case that we are entering, maybe not even, we've already entered an era that's going to require a very different playbook than the past 20-ish years. And if you're right, and it requires a different approach with the real type of risk management that you're talking about, then you as an investor have to say, okay, great, can I execute that playbook myself? And if I can't, and I'm going to guess most of the things you mentioned, or a lot of the things you mentioned, people have never even heard of. So for most people, it's like, look, don't try to figure this stuff out on your own in the dark in real time. Try to find a firm or an expert that can be your guide here on this. You're making a really great case for what your firm can offer.
Adam, I want to be clear. If somebody has a legal issue, they don't defend themselves in court. If somebody has a
There
health
you go.
issue, they don't go and
You don't
operate on
perform your own
themselves.
surgery.
Yet somewhere along the way, people have been taught that there is no such thing as expertise in financial markets, that anybody can be an investor. It's easy. And you know why that is? Because it has been, you know, but guess what? It's not always easy. You don't need to go to the doctor if you're healthy. If things are fine and you don't have any legal issues, yeah, you could go on ChatGPT, have it write up a legal document for you. But if you have a health problem or you need expertise, you probably want to hire somebody who's been doing it for 20, 30 years at a high level, right? And understands the issues at hand. It's not like,
Very well
it's just
said.
like any other business, any other industry. You become an expert at 10, 20,000 hours. You know, people like me have been doing it for 200,000 hours. So hopefully, you know, we've learned a few things along the way.
All right. That's one of the best ways to express what I try to express on this channel in almost every video. So thank you for giving me. I'm going to steal that going forward here. And again, folks, I'm impartial on who you work with. If you end up working with somebody, I just want to make sure that whatever decision you make is the best one for you in terms of stewarding your financial future from here. So Kai, for folks that have really enjoyed this discussion, are now thinking, oh my God, sorry, Cem. Cem is wicked smart, and this whole approach sounds really interesting. Where can they go to find out more, I guess, first about your funds, and then just follow you and your work?
Yeah, so we have again, two businesses. High Volatility is our fund NFA regulated entity. You go to kaivolatility.com. You can also go for our wealth advisory offering to kaiwealth.com. You can also feel free to follow me on Twitter or X at jam_croissant, croissant, I guess I should say, and feel free to reach out that way. But yes, we are accepting customers. To be clear, we have a $2.5 million minimum, so we're not taking smaller entities on the wealth advisory side. But yeah, we can talk for significantly lower amounts on the fund side if that's something that's of interest to people.
All right, fantastic. So, Jim, when I edit this, I'll put up the links there on the screen to all those URLs. Folks, they'll be in the description below the video too, so you can get there with one click. Jim, again, it's just, you are definitely the right man to talk to in this moment. Such a phenomenal, great conversation. Folks have been clamoring to have you on. I hope, folks, we really scratched your itch here. Jim, you got an open invitation to return anytime, but let's make a soft date to have you come back on again in a quarter and just call an audible on where things are there. At the end here, just parting advice for folks. If I took good notes here, you expect the current volatility that we're seeing right now to continue for a bit longer. It's going to be whippy, as you said. And then, perhaps we start the real grind down, towards eventually a total decline of 35 to 40%. Bonds aren't helping out, right? Just sort of nothing seems to work. Any bits of parting advice just for regular investors trying to not become collateral damage through all this?
Yeah, I think be patient pick your spots, but also don't get married to a position that you're in. I had a saying that I would tell my market making team when we were 13% of the volume, the S&P 500s during the S&P 500 options during the great financial crisis, right? And people would invariably make a bad trade. They would make a mistake. And the number one thing I would tell them, which is very true and is held true this week and this month, is cover the bad position, get yourself back to even, and then just get back in there and position yourself the way you actually have conviction in, right? Don't hold on, hope for a better outcome. So my advice is, it's not too late. We did talk about this 6 months ago. If you missed it, that's okay. There will be opportunities to get back into a better situation. It may not be, you may not have top ticked it, you may not have whatever, but you can get back on sides and then get to a position of strength where you can then start to compound and make wealth. There's a lot of time. The most valuable thing we all have is time. And if you can get back to a good, get back to even where you are, I mean, even being, to a neutral disposition, and then deploy a good approach to investing, it's not too late. So that would be my biggest advice to people is don't get married to a thing and say, well, I hope it rallies back so I can get out. That's how you end up in a really bad situation. This is a decade-long outcome. You will get, don't do it all at once in terms of a rebalance. But our general, again, not investment advice, but our general advice is to look forward to the better opportunities on a risk-adjusted basis and work into rebalancing.
All right. Well, very well said. And for that key asset of time, I very much appreciate you spending yours here with us for the past hour doing this, Cem. It's always wonderful. I should have called out earlier that you're wearing your strawberry jam shirt there. Thank you so much.
This is my cape we talked about, right? Yeah.
Exactly. Yeah. Yeah. I told Cem not all superheroes wear capes, but sometimes they wear strawberry jam shirts.
Exactly. This is our celebratory, shirt. When things don't go well, I wear rhubarb.
Okay. All right. Well, let's hope the strawberries stick around then all year.
Yeah.
Cem, can't thank you enough.
Wonderful being here, Adam. Always wonderful to chat with you. Thanks for having me.